Hey, what's up everyone, and welcome to the School of Personal Finance. In today's video, we're going to talk about inflation. So with fresh stimulus checks hitting people's bank accounts this week and interest rates steadily on the rise, people are getting nervous out there about the prospects of much higher inflation in the years to come. So in this video, I'm going to talk about what inflation is, why people are starting to really freak out about it, and how you could go about preparing yourself for what I believe is the inevitable increase in inflation. And make sure you stick around where I share the last thing that I think will benefit the most from high inflation, and it might very well surprise you when I tell you what it is. All right, let's get to it. So now inflation is a hard concept to wrap your head around, but really all it is the rate of increase for prices of everyday goods and services. And what we do is we take a basket of everyday items and we measure the price increase from one year to the next, or from 1 month to the next. So for example, if we have a basket of goods and they cost $100, and then a year later we take that same basket of goods and see what the cost is, and it's now $103, that would be a 3% inflation rate. There's been a 3% increase in the cost. But inflation could also be defined as the rate at which your currency is going down or being devalued. So if we even take a step back and look at a longer time period, an example I like to use is pizza, because I love pizza. So if we go back 30 years, when I was in middle school, I used to be able to, after a long day of playing basketball with my friends, I used to be able to go walk across the street and get a slice of pizza for $1. And if we fast forward 30 years to right now, that same slice of pizza will now cost me $3. So nothing has changed except for the value of that dollar. The dollar looks the same. The pizza has all the same ingredients. It has the dough, the cheese, the tomato sauce. Nothing has changed as far as those two components go. But my dollar is worth so much less that I now need 3 of them to buy the same good. So that same dollar will only buy me 33% of a slice of pizza. So it has gone down by 67% over that period of time, and it only has 1/3 of the value left. That is an example of inflation. And it's very scary because there have been times throughout history, like in Germany after World War I, with Venezuela, the one that you most recently hear about, where they lost confidence in the currency, the government lost control, and they had hyperinflation. And all of a sudden, the paper money, it wasn't worth anything. And that's where a lot of people are starting to think the United States is going because of the money printing, the stimulus, the way that the Federal Reserve is just buying government debt and just printing it out, printing the money and sending checks out to people. So there's a lot of concern about that right now in the overall population. Now, the economic metric that is most often used when measuring inflation is called the CPI, the Consumer Price Index. And what they do is they take a basket of goods and they take the average price change among those basket of goods. And now they also look throughout different cities and take the average through all different cities as well and come up with this number that tells us how much inflation there is in the country. But now it's not a perfect system, and it is very confusing and complicated. So depending on different trends that are going on, they might swap one good out for another. For savings and investments, they're not even included in there. So for example, with the government sending checks out to people, the stimmy checks, if people take those checks and they stick them in their savings account, or they decide to buy assets with it like stocks, that doesn't count towards inflation. That is not included in the inflation calculation. So the CPI is the metric that is used, but the public, they don't have much confidence in that number. They think to themselves, you know what, I'm going to the grocery store and it costs me a hell of a lot more than it did a few years ago to feed my family. Or I'm going and getting gas and it costs me a lot more than it did just a few months ago. It feels like there's inflation in this economy. The cost of living, it feels like it's going up no matter what the government is telling me. They're saying that we have 2% inflation, 2.5% is the target, but it feels like it costs me a hell of a lot more to live day to day than 2% increase from year to year. So with the US national debt just passing $28 trillion and the money supply in this country looking like a hockey stick, when you look at the chart, there's been an explosion in money printing over the last couple of years, just flooding the system. And now talks about another $3 trillion spending bill for infrastructure being thrown around. People are scratching their heads. They're wondering, how long can we keep this up where we're just printing money and the debt is exploding? And it's a very difficult question to answer. There's so many different variables that go into that, but There are hopes of an economic recovery, a growing tax base, the economy growing at higher rates as we come out of this pandemic, but is it going to be enough to support where we're actually going to be able to, at some point, start paying down this debt? And now we're starting to see the 10-year bond rates rising, and that's the last thing that the government wants is higher interest rates, where when they have to roll this debt over, how are they going to service it if the interest rate on these debts is much higher? And just to even take a step back and think about, how does all of this even work? How do we print money and just flood it into the system? And it's different than it's been in the past. We're at a new stage in monetary policy where the government, they've been borrowing money forever, right? So the government, they could issue bonds where investors will go out, they will buy these bonds and basically lend the money to the government. So you could buy a bond from the government, you could take $10,000, buy a treasury bond. So you're giving your 10 grand to the government, they are borrowing it from you, and they're gonna pay you 1.75% or whatever it is over the next 10 years. And that's how they borrow money. But they are borrowing so much money and issuing so many bonds that the Federal Reserve is now having to step in and monetize the debt. What they are doing is they are literally just printing money digitally, and they are buying these bonds. So they're creating money out of thin air, using that money to then lend it to the government, so the government could go ahead and send checks out to people or invest in infrastructure or whatever they're doing with all this money. So that is how it is working, and it is a new level in monetary policy, and one that many are afraid is going to end very badly. Now, if we look back to the late 70s through the 80s, now I was just born in 1978, so I don't remember any of this, but there was high inflation back then. Through a 10-year period, inflation averaged close to 9% during that time. And you hear stories about, when I was little, mortgage rates were 16%, or I used to be able to get a CD in the bank at 13%. And those days have been long gone. We really haven't seen high inflation rates since then. So in the 90s, the 2000s, 2010s, all the way up until now, inflation has really done nothing but go down. And we've been down below 2% for a while now. So if we do revert back to the mean where, the average inflation rate has been over 3%, if we go all the way back in history to the early 1900s, it is averaged around 3.3%. So considering it's been so far below that for so long now, it's a very rational assumption to think that inflation is going to be higher than the average, and it's going to stay there for a while. And inflation is a scary thing. Like, it could just hit you like a ton of bricks and explode on you, and then the government has to take drastic measures to try to save itself. So it's something that you want to be preparing for. And just to throw my disclosure in here, I'm just giving you my opinion. Take it for what it's worth from some, random person on YouTube. And any investments that I mention in here, it's not investment advice. I don't know anything about your situation. This is just for education and entertainment purposes only. All right, so now I want to walk you through some ways that you could prepare. What actions can you take if you believe that there is going to be inflation in the years to come? And now, just because you feel there's going to be inflation, or I feel there's going to be inflation, or you hear very smart people talking about inflation is definitely coming, and you see it on CNBC or on YouTube or whatever, that doesn't mean that it's going to happen. And if it does happen, it might not happen for a very long time. I thought inflation was going to start coming back in 2009 and 2010 as we rebounded out of the Great Recession, and there was a lot of money printing and stimulus and government intervention, but it didn't happen. There's been a whole decade where inflation has been very low. So maybe I was early, or I was just wrong. So no matter what people say, you can't take that, and you can't take your whole portfolio and bet on you being right, because you just might not be right. You don't know what is going to happen in the future, and nobody does. So the best thing to do in this type of environment is to prepare yourself, but to be very well diversified and have your money spread amongst many different asset classes in many different parts of the world, because you just don't know what could happen in the future. But you don't want to push all your chips and place everything on one bet where you could very well be wrong, and everybody around you could be wrong. We just don't know what is going to happen in the future. All right, so with that said, here are some prudent things that you could do if you believe that inflation is going to be coming. Or even if you don't believe inflation is going to be coming, these are still things you could do. Just have a very well diversified portfolio, because there is a ton of uncertainty out there. All right, so the first one, and we've already seen a big increase, and that's in commodities in general. The price of oil is up, copper, steel. Like, if you want to build a house right now, it costs a ton more than it did just 5 years ago to build a house. The prices of cars have gone up. So commodities in general, those prices, they've all gone up, but that is a good place to go if you think there's going to be continued inflation. Number 2 is precious metals, specifically gold and silver. So people talk about gold and silver all the time being a hedge for inflation, and it has passed the test of time. It has been around forever. Gold has always been equated with money, and when currencies do collapse, they end up getting pegged back to gold and starting from there. So gold is a place where people run to, people go when they think there is going to be inflation. Now, I don't know if it's a great inflation hedge as so much as it's a fear play. When people are very scared, they're scared of the government, they're scared of, laws and things that are going on. People run to gold as a safe haven when there is elevated fear in the market. So between fear and inflation, the combination of both, gold tends to hold its value and do pretty well in times of uncertainty and of fear and of anticipated inflation. And now number 3 is an investment that does well during inflationary periods, and that is TIPS, or Treasury Inflation Protected Securities, issued by the government. So they are bonds issued by the government, but they have a little kicker, a little inflation kicker in them. So say, for example, if TIPS have a 2% coupon, a 2% yield, an interest rate of 2%, they will continue to pay that coupon, but then they will also adjust the actual principal value of the bond up or down depending on inflation. So if there is inflation, say you have a $1,000 bond and there is inflation, your bond would be worth, say, $1,050, and then you would get the 2% interest rate based off of that. So in times of inflation, the principal value of your bond is going to increase with the rate of inflation. But in deflationary times, when there is no inflation, when there's actually deflation, then you could lose money in TIPS. So TIPS have not done great over the last decade because inflation has been nowhere to be found. But going forward, that is a place where you could go to if we have increased inflation, that those will rise in value. All right, and then number 4, I'm going to throw cryptocurrencies out there, or Bitcoin. Now, personally, I'm not using this as a hedge against inflation. It's too speculative for me, too volatile, and it doesn't have a track record. I don't know if it's going to be a good inflation hedge, but you have to assume that if the government keeps printing money and people are very worried about the dollar and they want to get off the system, that Bitcoin is a good place to do that. Now, I'm sure that the government could come in and try to control it in one way or another, but there are many people that are flocking to Bitcoin to get away from the dollar and to get out of this government-run system of printing money. So Bitcoin, to have it as a piece of your overall portfolio, it might do very well in times of high inflation, but it just hasn't been proven yet. And for those reasons, I'm not personally investing in it, but many others are. Many others that are smarter than me. And then number 5, believe it or not, are stocks. Stocks tend to do pretty well during inflationary times. Now, there might be a lot of volatility and there might initially be a big pullback in the market as we try to figure out what's going on with interest rates and with everything. But stocks typically, they do pretty good during inflationary periods. And now number 6 is one of my favorites, and if you watch my content, you probably know what that is, and that's real estate. So real estate typically does very well during times of inflation because asset values are going up. And it's not only the value of the property, but if you have rental real estate, the rents are typically going up as well during inflationary times. So owning real assets, owning real estate, it's usually a good way to go if we are expecting inflation in the future. And now with real estate, obviously there are a lot of factors that go into it. So I'm not saying just buy whatever real estate you could get your hands on, that it'll go up in inflationary times, because that might not be true. Like right now, I don't want to go near any of the overvalued city type of areas. I would much rather be investing in lower cost of living areas that have a lot of room for growth. So you do have to, it's very market centric, and you do have to look at the data and where people are moving to, where they're moving away from before pulling the trigger and investing in real estate. And now it's not just single family homes or duplexes or apartment buildings. You could also invest in REITs. If you don't want to own an actual rental property, investing in REITs is a good way to go about it also during inflationary periods. And now number 7, this is the one that I said might surprise you a little bit, and I've been trying to accumulate as much of this as I can over the last few years, and that is long-term, low interest rate debt that is tied to an asset, aka mortgages. So on my rental properties, I have 30-year mortgages. On my primary home, I have a 30-year mortgage, and I have no intention of trying to pay those down any faster than what is required of me. I don't want to pay off low interest rate long-term debt that is fixed and locked in if the value of the dollar is going to be going down. If we look out 20 years from now, if we really do have high inflation rates, higher than average, then the dollars that I will owe at that time, they will be worth much less. So it will be much easier for me to make a mortgage payment on a house 20 years in the future because it will not seem like a lot of money. And on top of that, the price of the real estate should be going up in inflationary times. So I could have real estate that is growing in value. I will have debt that will be devalued because the dollar is going down. And if you think about it, this is what the government wants. If the government has higher inflation than this $28 trillion in debt that they have, they will deflate their way out of the debt. They will feel like it's not that much debt in the future if the value of the dollar is so much lower. But it's a fine line because interest rates can't go up too high on them or else they can't service that debt. So in a way, they want to keep interest rates very low so that they can continue borrowing money at these low rates, but they also want inflation to start decaying or start devaluing some of this debt out in the future so they'll be able to actually pay it back one day. So what you could do is you could get yourself on the side of the government, borrow large sums of money, have it tied to real assets that are going to go up in value, and then pay that debt slowly over a long period of time as the dollar is being devalued. Now, this is a little bit tricky, and you have to invest in real estate in order to be able to do it. And I'm not suggesting that it's right for you and that you go out and take a ton of debt on, but it has to be good fixed rate, low interest debt tied to assets that will be appreciating during this time. Obviously, I don't think you should go out and borrow a ton of money on credit cards or on revolving debt where the interest rates can go up as rates start to, spike higher. So fixed rate, low interest debt, it's really an asset these days, and I want as much of it as I could get. All right, everyone, that is it for this one. Make sure to hit that like button if you enjoyed this video. Hit that subscribe button if you've not subscribed to the channel yet, and I will see you again next week. Thanks.